Hello and welcome to Trading Hour. I'm Sonal Bhutra. With me today is Vivek Iyer. Good morning, Vivek. Well, another day where we started on the from the lows, but we have recovered from the lows of the day. The Nifty is up around 92 points from the lows at that 24,429 mark. Mid-caps are supporting the gains that we are seeing today. Bank Nifty, which was the star performer yesterday, has come in for some profit booking. So that index is down 300 points. But if we talk about what's working in the Nifty right now, Bank Nifty, of course, supporting the gains from the lows that we have been talking about. So we have the likes of Kotak Mahindra Bank, which are at the day's high, and the other stocks as well. In fact, Marico is one of the stocks that is in focus, and that is reacting to earnings as well. So we'll just be chatting with the management as well in just a bit and talk about the numbers, the rural demand, and what's happening in the urban landscape as well. But if we talk about the stocks, some of them have recovered from the lows of the day, and we'll discuss that in greater detail. But as I said, Marico has reported a good set of second quarter numbers, largely in line with the estimates. To discuss the company's second quarter performance, we are now joined by Saugata Gupta, the MD and CEO of the company, joining us now. Mr. Gupta, thank you so much for joining in today, and festive greetings to you. Can you comment on the urban versus rural demand environment? Because other companies, they are speaking about urban slowdown. Do you see that trend happening for you as well?
I think over the last 2-3 quarters, we are seeing a slight improvement in rural consumption. Having said that, an urban which was doing very well, I think you need to bifurcate at the top end, I think, and which is also driven a lot by e-commerce, quick commerce, and modern trade. We are not seeing any significant reduction in consumption. At the end of, but in the middle class, I think because of a combination of, I would say, food inflation and overall retail inflation, we are seeing some stress. Having said that, I think once the inflation goes away, I believe that it will recover. So I think if you look at our portfolio, especially the diversified part of the portfolio, which is the premium personal care and the digital brands, that caters to the masstige and the top end, and there we are not seeing any stress. But yes, in the middle, where mass food brands and some of the other, HPC brands, completely cater to, yes, there is some little bit of a stress.
Well, moving it on, most important thing that the street is focusing on is the EBITDA margin. So what is the outlook for margins in H2? There's inflation that's being seen both in copra as well as palm oil prices.
We don't get impacted by palm oil. I think we are only impacted by other vegetable oil like rice bran and sunflower and obviously copra. There has been a price increase, a combination of the inflation in copra. Similarly, in our Saffola portfolio, there has been a duty hike, which has led to a 15% increase in input cost. We have taken price increases. We believe that at the end of the day, we want to maximize volume growth and revenue growth subject to a threshold level of margins. And as we indicated, we believe that there could be some, to the worst possible case of a 50 bips reduction in overall operating margin for the full year. But as you know, last year we had anyway peaked in operating margin. But I think what is most important, given the fact that we are seeing some improvement in rural, and historically, whenever there has been inflation, moderate inflation in copra, Parachute has tended to do better. We wanted to maximize revenue and the volume growth opportunity. So we will be looking at a sequential improvement in volume growth. We have done 3, 4, 5 last 3 quarters. We want to look at a further sequential improvement in volume growth.
Okay, there could be a sequential improvement in volume growth. So going forward, Mr. Gupta, what could the volume price mix be in the second half? Is double-digit revenue growth on cards?
Yeah, that's most certainly on the cards, given the price increases which we have taken in Parachute and Saffola. So I think we are pretty confident of delivering double-digit revenue growth. We'll also strive, although we have done around 7 and 8% in H1, we'll strive to ensure that we will attempt that can we do a double-digit revenue growth for the full year. And as I said, that we would be passing on some part of it, but it is extremely important that the consumer, given the fact that there's not exactly very strong tailwinds for consumption, we are careful about only taking calibrated price hikes.
Okay, so calibrated price hikes is what you're talking about. Now, moving to the food business, what are the margins of the food business currently? What are the margins expected by the end of FY25?
Food business makes much more margin than Saffola edible oil, and that's what we wanted to do. If you notice, we started this journey in sometime in 2020 when we said that we will be aggressive in food growth. There are three components of the food business. The organic part is essentially driven by Saffola oats and masala oats. And then there is the part of Plix and True Elements. Last year, we did a kind of a pause in terms of growth, and we corrected the margins. The margin is when we had a significant improvement in margins of 800 basis points. So food today delivers a good margin. Obviously, as we scale up, the margins will improve. And we are extremely happy that this quarter we hit 1,000 ARR. We had set this as an aspiration FY20 that we will do that. So we have done 4x to 5x on foods, and we want to continue to grow foods by 25-30%. So if we look at the Saffola franchise today, 30% is food, 70% edible oils. Over the next 3 years, this number will be 50-50, and maybe 5 to 7 years from now, food will be bigger than Saffola edible oil in the Saffola master franchise.
Okay, all right. So that's about the food business. But tell us, what are the expected benefits of the revenue scale and margins via Project Setu?
Setu is a project to drive direct distribution. We believe that there is a significant opportunity in driving quality distribution in rural, which will improve assortment. We continue to believe that rural will be a source of, rural direct distribution will be a source of competitive advantage, and it is a entry barrier as far as, it protects and creates moats for large FMCG companies. In the case of urban, it is going to aid diversification of the portfolio. We are under indexed in chemist, cosmetic, and food outlets. So going forward, and it's taking time, because anything which requires a complete change of operating model, it's taking time. Early signs are encouraging. We want to add 500,000 direct reach outlets in the next 3 years. So we believe this will lead to also help in diversification and also help in the urban, as you know, the urban GT distributors are in stress. This growth and expansion will help them in driving much more growth, because if you notice, a lot of food growth has been happening through OT when we started the journey some 5 years ago. It will also set the platform for selective distribution of our digital brands in GT. We believe in doing it carefully and not just spraying and praying in terms of distributing digital brands. There is a certain opportunity which we'll also exploit once this Setu distribution is in place.
Okay, all right, Mr. Gupta, thank you so much for joining in today with all those insights on the numbers for Q2 and most importantly, the outlook going forward. That's the word coming in from Marico. The stock is higher in trade, but it's time for a short break now. We'll be right back with Rahul Arora, Chairman and CEO of MPS, to discuss their Q2 numbers.
Welcome back to Trading Hour. Well, the broader end of the markets continues to do quite well. Two stocks from the broader end of the markets that are moving quite sharply post declaring the results today. First on our list is Container Corporation, or Concor. Remember, this is the second consecutive quarter that the company has actually missed the volume guidance that it had given at the start of the start of the year. Post that, what's actually happened was that the stock opened quite sharply lower, but the management came on the channel and they reiterated their volume guidance, post which the stock has recovered quite sharply up near the high point of the session. The second stock on the radar is 5-Star Finance. Now, this particular company, despite delivering a good set of results, the management has gone ahead and cut its FY25 growth guidance to 25% from 30% earlier, and has also gone ahead and reduced the yield that it is going to charge from its customers. On the back of that, quite a sharp cut to estimates from analysts, stock down by almost 12% in the session. But now shifting focus to the commodity space, Manisha joins in, and today we are focusing on crude.
Well, yes, thank you for that, Vivek. Well, even as most of the commodities have kind of done well, but not the crude oil prices, we're down by a negative 6% in this year until now. And the reason for that really is that you're looking at easing Middle East war premium, so that those prices or that premium really has come off the markets. And then OPEC is expected to increase production by 180,000 barrels per day for the month of December. The next OPEC and allies meeting is happening on 1st of December. So this almost seems to be going through right now. And then you also have the US production trading at at record highs. China's definite shift from diesel to EVs and electrification is something that the markets are taking in cognizance as well, and that has continued to put pressure throughout this year in case of the crude oil prices there. At this point in time, that bit of support that you see on your screen is because the US crude inventories have seen a decline much more than what the street was anticipating. And second, as the crude prices are trading at 70 and below, especially for WTI, the US is looking to increase its holdings in the SPR as well. So that is where some support in the market seem to be coming from. But apart from that, when you look at this year, as I said, we are down by 6% YTD, and on year-on-year basis, we are down by 15 to 16% for the crude oil prices. Good news for the Indian markets as we import nearly 88% of our requirements, but clearly the kind of weak demand, higher supplies that is looking at into the markets, further declines not ruled out.
Okay, further declines not ruled out. Thank you so much, Manisha, for joining us as always and telling us what's happening in the commodity markets. From commodities, let's get back to equity markets and talk to another corporate. MPS saw its revenue from operations surge 38%, EBITDA rose 32% on a YY basis. The margins came under some pressure. To discuss this and more, we are joined by Rahul Arora, who is the chairman and CEO at the company. Mr. Arora, good morning. Thank you so much for joining in. Well, your revenue growth in first half was 37%. You had guided for a 25% revenue growth in FY25. Do you think there will be an upward revision to the guidance? And also segment-wise, you've done better than the guidance that you'd given. In the content biz, the platform business has seen a substantial growth. Is there possibility of upward revision to segmental growth as well?
So thank you for having us on your platform. So a couple of years ago, we articulated a fairly bold vision that we want to get to 1,500 crores in revenue at similar margins by FY28. And while I'm not super thrilled to keep reporting progress in that vision, I think we are all working really hard at MPS to make sure that we reach the halfway mark on the vision by the end of FY25. And that's really our focus right now.
So will you exceed that guidance, or it's going to be 25%?
So again, we're gunning to do our best. Not comfortable sharing specific guidance, but we're gunning to do our best. And things are looking good, as you can already see from our results.
Okay. Mr. Arora, when we are talking about the EBITDA margins, there's been quite a significant dip on a year-on-year basis, almost 500 basis points compression. Now, despite the higher top line, typically in your business, don't you see operating leverage, benefits that does kick in, or is it because of a weaker mix that we are seeing a compression as far as margins are concerned?
Yeah, I think if you dig deeper, the margin erosion really happened back in Q1, and largely because of an acquisition that we did earlier this calendar year in March, which was a loss-making company, which we very quickly turned around. So going Q2 onward, our margins have come back on track and only perform better from here. So we had an extraordinary event where we took over a company that was loss-making, have quickly turned it around, and from Q2 onward, we're back to our old margins of north of 30% EBITDA. So the suppression really just took place as a one-time event in Q1.
So FY25, will you end with 25% margins? Because I believe that's what you had guided at the end of Q1.
So again, our goal is to get back to the old levels of margins, which is north of 30%.
Okay, so that will happen in FY25 itself.
Again, not thrilled about giving tight guidance that way, but in the long run, yes, we want to be at the 30%, 32% range.
But you have given guidance in Q1. What is stopping you from maybe reiterating that or changing that right now?
Yeah, so there is no change to the guidance. The business is doing really well, as you can see from our quarterly results. It's just that, as a board, we've reconsidered this approach to giving quarterly guidance based on feedback from several minority shareholders. And therefore, we're focusing on FY28. And again, there's no change to our approach. The business is doing really well. We had a wonderful Q2, wonderful first half of the year, and that progress will continue to the rest of FY25 as well.
Okay, Mr. Arora, so, in the first half of the year, if you're looking at, the indicative guidance that you had given of close to 25% revenue growth, you've managed to achieve almost 37% growth. So are you expecting some moderation as far as H2 is concerned? And even when it comes to, margins, 26.4% is what you achieved in H1. So again, some moderation, further moderation expected, and will it also be because of the recent acquisition?
There is no moderation, only optimism ahead. Like I explained, the erosion that had to happen is in the past, in Q1. So there is no moderation, only optimism. And going forward, things are looking really good. Q2 is a start of something very big. And things will only improve from here. There is no moderation.
Okay. A significant portion of your newly acquired AGE's revenues, they come in from China. The company projects that China will contribute around 15 to 20% of consolidated revenues going forward. What is the current geographical split? How will China contribute going forward to overall revenues?
Again, as you described, so we're not just seeing this as a China opportunity, but rather an Asia Pacific opportunity. So Asia Pacific now is 26 as per Q2, 26% of our revenue, and almost north of 35% of our PBT. So as a region, Asia Pacific has become increasingly more strategic and important to us. And the large reason for that is while the market from a total addressable market standpoint is smaller compared to the Western markets, the growth rates are much higher. And we're essentially capturing on those growth trends that we're seeing in the market. So if I have to take a guess, Asia Pacific as a total percentage of revenue will only increase from here, given the overall macro trend that this market is growing much faster than some of the Western markets.
How much faster is it growing? If you can give us a sense of what is the growth in other markets versus Asia Pacific, which makes you so confident or bullish on this particular geography?
So if the global market, e-learning market is growing at 10-11%, Asia Pacific is growing at 15-16%.
Okay. Want to understand one more thing. Revenue mix currently largely skewed towards content solutions. So by the end of next year, will that continue? Right now, we believe over 50% is coming in from this particular business. So end of FY26, how do you expect the revenue mix to pan out?
So while we look at our business, when we report our business in segments as content, platform, and e-learning, we actually attack the market as research, education, and corporate. These are the three markets that we attack. And then content, platform, and e-learning is simply a toolkit to acquire market share. Having said that, if I had to make an educated guess, in the long run, it'll probably be a third. And the reason I say that is we are intuitively seeing that the platform play and the learning solutions play is growing much faster than the content piece, as well as a lot of the inorganic considerations that we're making on the acquisition side are either some form of platform play or some form of learning solutions play. So, in the long run, I think they will be equal with much of the short-term growth coming in the platform and learning solution space.
Okay, all right. So that's the plan going forward. Thank you so much, Rahul, for joining in today. And season's greetings to you and everyone at MPS Ltd.
Thank you so much.
Okay, on that note, we'll slip into another break. When we come back, we'll discuss market technicals with Mitesh Thakkar, talk about top trading bets as well, and a lot more. Stay tuned. Welcome back. Well, some more recovery which is underway. Nifty is down just 11 points as we speak. Mid-caps have surged further. That index is up 445 points. And the bank Nifty is lending the support that we're seeing on the Nifty as well. So there you go. Nifty at the day's eye, just at the flat line. We could see some green there very soon. Something that happened yesterday as well, and something that we could see. Of course, we've not seen it yet, but there is a possibility. Mitesh Thakkar is joining us for a quick technical check on the markets. Mitesh, do you think this recovery could continue? What are the next important levels to watch out for on the Nifty?
So I've been actually advocating for the recovery to extend for next few days. Typically, a pullback post a correction, or I would say a rally in the declining trend is volatile, and that's what we saw yesterday as well, when the markets were negative in the first half, then recovered, and today also we started negatively and now are trying to recover. So I think this choppiness will continue, but overall I think the Nifty is looking towards possibly a test of it's looking at a test of 24,500, which is the first target, and then 24,750 is my eventual target. So I think we still have some more legs to go on the upside. A lot of stocks are reversing from oversold levels, so I think that's where traders can look at exploring long positions.
Okay, thank you so much, Mitesh, for joining us. Any individual picks you have for us today?
I do. I have a buy on ACC, and the cement pack is looking very strong. So ACC is a buy with a stop below 23.45. Look for targets of around 24.50 over here, maybe a bit more, but that's the first target on the upside. And the other one which I like is LIC Housing Finance, which I would recommend buying with a stop below 635 for targets of 670.
Thank you so much, Mitesh, for joining us, for giving us a view on the market as well as individual stocks. Well, moving on, as CNBC-TV18 celebrates 25 years of excellence, we invite you to the most anticipated event of the year, the CNBC-TV18 Global Leadership Summit, bringing together visionary policy makers like Finance Minister Nirmala Sitharaman, RBI Governor Shaktikanta Das, industry leaders like HLPC India's Hitendra Dave, Kotak Mahindra Bank's Uday Kotak, and trailblazing startup founders. This is where the roadmap for India's next 25 years of growth and global leadership will be charted. You don't want to miss this.
Welcome back. You're still tuned into Trading Hour. Well, one of the stocks on our radar is Cipla, which fell as the street is not too enthused by the subdued India business growth and how the US growth was impacted due to temporary supply issues in one of their drugs. The company said that drug issues are expected to be resolved by the end of Q3 FY25. The domestic branded formulations business was impacted due to slow seasonal growth. My colleague Vinny Motiwala spoke to the CEO Umang Vora on the outlook for India business and a lot more. Listen in to what he had to say. The stock is lower by 4%.
For sure, the India business trajectory, the second half will be much better for a couple of reasons. I think respiratories are as a key franchise, and for that, the season typically starts now, October, November, and then continues way on until February. So I think we're seeing a strong trajectory, expected trajectory for it in this period. Plus, I think the chronic franchise that we have is going higher than market. It has grown higher than market in the first half of the year. We expect that to continue. We've added almost 800 to 900 people in this year in our field force, and we expect that those additions to start resulting in some amount of sales. So I think yes, the second half of the year is going to be faster than the first.
Okay. Also, on terms of the lanreotide drug, where you mentioned some bit of a supply disruption and challenges currently. Also, today there was something that came in that Ipsen has confirmed Sun Pharma also launching this drug by June 2025. Do you think then the slowdown that we are seeing right now, maybe that could continue even next year or eat up in terms of the share that you're seeing there?
I'm not aware of the income, the launches from people. I think we expect to be pretty much back on track with our supply start production's already on. So hopefully Q4 onwards we should be okay. Late Q3 and Q4 we should be okay with our supply. I'm not aware of any slowdown. I think the market is quite big to accommodate multiple players.
Okay, so no worry on that front. And just lastly, in terms of any updates on the launches on the peptides respiratory inhaler front, and margins have been quite good compared to your guidance. So is there any change on that front for your guidance?
No, I don't think any change to guidance. Typically for us, Q4 is a slower guidance from a operating margin perspective compared to the rest of the quarters. So no change in the guidance. I think peptide launches, we're expecting them to start coming, hopefully over the next 6-month period. We've got a few peptides that were approved, the smaller ones. But expecting more peptides to start getting approved over the next 6 months.
Okay. And just lastly on US business also, what is the growth that you are expecting there going forward? What do you think will be leading the growth there? Any launches on that front specifically?
No, so I think the US in Q3 will not be as big because of the supply issue on Lanrio. But I think we are bouncing back in Q4 quite significantly from that aspect. I think US is completely dependent on launches. We're guiding to a normalized base for Q4, in the range of 230 to 240 million. That's a normalized base for the US business. Now, if the launches come, they add to this.
Well, a very interesting conversation there with Cipla, guiding to a slightly moderation as far as the top line is concerned in Q3. But moving on, let's now slip into a short break. Up next, we'll discuss the second quarter earnings of Greenply Industries with Manoj Tulsian, the MD and CEO of the company.
Welcome back. Still tuned into Trading Hour. Well, Greenply is the stock on our radar, reported a stable set of second quarter performance. The company's profit after tax was impacted by one-offs and high depreciation. To discuss more on the demand trends, the performance and the outlook, we have with us now Manoj Tulsian of Greenply Industries. Mr. Tulsian, good morning. Thank you so much for joining in, and festive greetings to you and everyone at the company as well. It's been a stable quarter for the company. You've seen that the plywood realizations, they've gone up by 2.5%. Plywood volumes have gone up by 6%. What is the outlook for the remainder of the year? Will you be able to do this number or maybe better that in the second half?
Hi, Sonal. First of all, very good morning to the channel and festival greetings to all of you. We wish that the coming year brings a lot of happiness and prosperity for all of us. Coming back to your query, yes, we feel that the second half would be better than the first half. We are given annual guidance of doing a volume growth of anything between 8 to 10%. H1, we have right now been on 7.2% on the volume growth. So we feel that we'll be able to catch up, and we would land anything between 8 to 10% for the full year on volume growth.
Okay, Mr. Tulsian, but when we're talking about the MDF segment, on a year-on-year basis, sequentially, there seems to be quite a bit of weakness over there. At the start of the year, you had given a guidance of close to 50% volume growth. Do you stick to that guidance? And also, what caused the dip as far as the volumes were concerned in the quarter gone by?
Absolutely, Vivek. We are still holding on to our guidance of 50% plus value growth for the full year. We are very much on target. Quarter two, actually, we had a shutdown for almost 7 days. And since we don't carry so much of inventory at this point of time, we could not make up for the lost sales. It was a planned shutdown, but in H2, I'm sure that we'll be doing much better than H1 in the MDF segment, and which means that we will still stick to our guidance of 50% plus for the full year.
Okay. Mr. Tulsian, generally, how is demand? Because we've been getting mixed pictures. Some are saying that demand is not impacted, while others are saying it's more in the urban area now. Is that something that you're seeing either in the plywood or the MDF segment as well? Something on ground that's happening?
Well, look, the demand scenario I won't say is bad. It can definitely be better. Quarter two, there was a bounce back after a dull quarter one, especially we all know that, during the election period, even at the government machineries, most of the decisions gets delayed till the new government gets formed. So there was a bounce back in quarter two. And I think, the good trend will continue because there is a good period of 4 to 6 quarters, time lag, which is already almost past. So if you really see on the real estate side, there was a period when after the pandemic, most of the developers were trying to first of all liquidate their existing present inventory. And the new launches were very, very slow. And then once those inventories were being sold, then the new launches have come into picture. So keeping that in mind, ours is interior infrastructure. So we are the last one to get the benefit of the same. And many other players in the building material segment. So I think the traction is there. It can be, of course, at any point of time, it can be better. Also, just some pointers when I was looking at a few data in quarter two, slightly I had a concern that the number of units sold in real estate versus the number of new launches which has happened. The number of launches which has happened is slightly lower compared to the number of units sold. I think that's where possibly we'll have to look at the new projects which is there in the pipeline, and it has to catch up. Otherwise, there can be a challenge going forward again. But I think for sure, things will only improve from here.
Right. Mr. Tulsian, let's come to the furniture fittings part of the business. You had indicated that by November, you expect at least, one phase to come in. What was the operational loss that you saw in the quarter gone by? And when do you expect to turn around this particular segment of the business? And what are the targets that you've set internally over the next couple of years for the furniture fittings part of the business?
So, quarter two, we lost around 3.5 crores. That is our share. So it's a 50-50 JV, right? So as a entity, it lost around 7 crores. Our share of loss was around 3.5 crore. There has been a delay in terms of, getting these machineries. imported because all these machines are made in-house by our technology partner, Samet. But almost there was a delay of 2 to 2.5 months. So all our plans of execution in Q2 got shifted to Q3. As where we stand today, we just got the machine around 10 days back. We have done our first trial. The first trial has given very good results. So we are now going to go to the market with the full range as per the phase 1 starting November. Give us a few months and I will be in a much better position to give you the numbers and other thing. But given internally, we have challenged ourselves that in year 1, which is FY26, we must do a revenue of around 100 crores, which can take us to near break-even. That is our first target. And in the next 3 years, starting FY26, we want to build up this business at a very rapid speed. If things work out well, we should be doing around 450 to 500 crores.
Mr. Tulsin, we're running short of time, but I want to squeeze in 2 quick questions. Number 1, timber prices have gone up. We are also seeing quite a significant jump up. So how does that impact your margins? And also the BIS, as far as implementation on MDF has been delayed by a year, how does that impact you?
No, so the timber prices went up and then it again came down also. So while we speak right now, it has slightly got corrected again. In Q2, we have taken a healthy price increase of almost 2.5%. This was almost after 5 to 6 quarters. The market has able to absorb the same. So we are not worried on this. If the timber prices continue to slightly move up, maybe we'll have to look at one more price increase. As far as the plywood is concerned, as far as MDF is concerned, we have been able to do a good job on the value-added products. And beyond that, we are also taking a price increase starting November. So that way, we will try to protect our margin from any further erosion. And then we are taking a lot of other efforts to see that, how we can improve our margins further.
Okay, all right, Mr. Tulsian, thank you so much for joining in today and giving us all those details. So that's the word coming in from Greenply Industries. They talk about the demand trends and also about their guidance going forward. Let's talk about some earnings now. Voltas and Kaynes Tech are in focus after posting results. Upasna is here with the earnings fine print. Upasna?
First up, let me start with Voltas. The company reported in-line set of numbers. Revenue and EBITDA margin was largely in line to our poll estimates, but there was a slight miss on the PAT number. Now, sequentially, numbers look quite weak as Q1 was a strong quarter on the back of summer sales. Now, coming to consolidated revenue of the company, it stood at 2,619 crore with an uptick of 14%. This was mainly driven by the strong growth seen in company's UCP segment, which is nearly 60% of the company's revenue mix. Now, coming to EBITDA stood at 162 crore with an uptick of 1.3 times on a YoY basis, leading to margins of 6.2% versus 3.1%. Now, margins in company's MPS segment recovered and turned positive, which led to a boosted margin growth. Now, PAT stood at 133 crore, which was up 2.7 times on a YoY basis. And mind you that the company has indicated that its engineering services segment has faced certain demand headwinds. Hence, this stock remains in focus. Next up is Kaynes Technologies, a good quarter, in-line set of numbers reported by the company in tandem with the street estimates. Revenue PAT was in line, but margin was much above the street estimates. Now, coming to revenue, it stood at 572 crores with an uptick of 58% on a YoY basis. And company's margin stood at 14.4% with an uptick of 90 basis points. Company's PAT stood at 60 crore with an uptick of 88% on a YoY basis. Hence, both these stocks remain in focus today on the back of their earnings.
Thank you so much for that, Upasna. Well, moving on, it's time for a short break. We'll get you more on the markets on the other side.
Welcome back. You're still tuned into Trading Hour. Let's talk about IOC. Reported a very weak set of Q2 numbers. In fact, it was the weakest in the OMC space. Revenues fell almost 10%. Profits came at 180 crore rupees. This compares with 2,643 crore rupees in the previous quarter. Reported PAT included reversal of provision created towards VAT input credit. Strip of that, it would have been a loss as well. My colleague Sapna Das spoke to the Director of Finance of the company, Anuj Jain. He's optimistic on future profitability as margins are likely to recover in the second half. Listen in to that conversation.
See, oil sector doesn't work on quarter-to-quarter performance because we are sitting on a lot of inventories. Because we have 9 refineries pan-India basis, we have Panipat, we have Mathura. So we are sitting almost a 1 lakh crore of inventory in our books, whether it is crude oil, whether it is finished goods. So if the prices in the international market come down, we take a lot of inventory hit in my books of accounts. Apart from that, if you would have seen, the refining margins have also come down in the recent past. And so if you put together all the oil companies, whether it is my company or other companies or CPCL, MRPL, everybody has got because of the inventory losses as well as the poor refining margins in the system. As far as pain point is concerned, I would only say that it happens whenever the prices come down. But now taken the hit in my books of account, now onwards, since I almost have a 45 to 50 days crude oil inventory, whatever I buy today or in the past 1 month, now that crude will start coming in my system. And when I sell that crude, then I will start making profitability. So it's a one-time hit all the companies take, and then onwards it becomes a positive trajectory for other companies. So this is how I would say that it becomes in the oil sector whenever, if in the past 10 years you would have seen, whenever the prices come down.
Okay, so has it been a shock, global crude coming off its highs, and do you see this stabilizing now? Number one. Number two, quickly on the LPG side, what are the concerns? Because the numbers there are quite big as far, not just IOC, but the other companies also, like 45 or 100 crores is, I think, HPCL's number. Yours around close to 9,000 odd crores, a negative buffer. So where do you see the situation, both on global crude prices and the LPG situation?
See, I'm not expert in this, but what we discuss internally, there are two factors. One is the international geopolitical tensions. It is putting the pricing upward trend, but it pushes the price upwards. But there's a lot of demand destruction in China and many of the countries in the world, and there's excess capacities in the world on crude oil on the product side. So the contra side, the geopolitical factors are making the prices up, but the other factor, particularly the demand destruction in many of the countries, is putting the prices down. And going forward, I think the world itself is seeing that India is a bright spot. We have continuously high demand, but being oil sector is not a country specific. Anything happens in the world affects the oil prices. Even if you see in the past few days, one news of Israel or Iran tensions going up, the prices go up by 5. Next day, the moment it shows, okay, they are not going to attack the refining system, the prices come down by 5. So highly volatile. So we are, it affects the companies like us who are continuously buying. But this is the way oil sector work. We always do our analysis on not on quarter basis. We do analysis on at least 1 year basis. Because if you see the history of Indian oil, we have many quarters, we have negative profitability, then we go on a positive next side. So it's a very unique industry where we work in. As far as the LPG is concerned, already all the oil companies have given a disclosure in the books of accounts that there's a negative buffer in the books, but definitely the things are being discussed, and I hope the things will become better soon.
Okay. One last thing, sir. Including other products, how do you look at your marketing margins? I'm going to ask this question that there is a price cap, so to speak, to an extent, in some way or the other. How are the companies coping with it, and how do you see the road forward, especially when your global crude starts coming off? Does it create issues?
See, we have basket of products, MS, HSD, LPG, so many other things are there. I think it's a basket of the product. Each product will have its own, like bitumen. Suddenly during the rainy season, it stops selling. Now it's the time we start selling the bitumen. So a lot of combinations are there. I would say we have the experience. All the companies have the experience of making this, quarter to quarter movements, transition. And it's okay. We are more concerned about the inventories what we carry, because suppose Panipat, 15 days it takes time from pipelines from Kandwa and Mundra port to come here. Then my entire inventory is in my books. So if the prices come down, I am at a loss. So that is the more concern area. Otherwise, it's okay.
All right, that's the word coming in from IOC. That's an exclusive conversation. But for now, we'll take your leave on this edition of Trading Hour. Stay tuned, more market action coming up on Halftime Report.